Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes made during the first week of January. The US equity market closed 2024 as one of the best years in economic history. The Fed remained consistent in its well-telegraphed path towards lower rates, at the same time leaving the door open to pause sooner than expected if conditions require a more hawkish approach. Undeniably, 2024 was a year that will have its own chapter in future economic books, perhaps exemplifying the first instance of economic deceleration without a landing or recession. Within that context, credit metrics, labor market, and to a certain extent, consumption figures have declined from all-time high levels, but not to the point of concern. Our proprietary recessionary indicator is assigning only an 11.64 recession probability in the US the next 6 months. It is reasonable to expect a more volatile first half of the year, where the market will have to parse, dissect, and adapt to the policies that the new administration is expected to implement. Decisions related to tariffs, massive deportations might have an inflationary impact which could derail the Fed's ability to continue cutting rates. However, regulatory easing, a broadening of AI-related capital spending, and a change in energy policies could further support US exceptionalism. One of the biggest questions for 2025 revolves around the direction of the US fiscal deficit. Ex ante, it is expected to worsen as a result of combinations of actions such as tax cuts and other fiscal benefits, as well as an increment in government spending. This could be partially or completely offset with the drastic optimization and cost savings plans that Elon Musk is proposing to deliver, although it remains unclear how and when these are going to be implemented. In the US equities front, we have introduced an active large cap blend manager. The manager has a dual allocation to growth and value companies with a 20-year track record, not only outperforming the S&P 500 index, but also displaying a persistently lower historical level of volatility than the index. The rotation into the manager comes from reducing value-only exposure. The allocation to long-short active management in Europe was augmented to account for the subpar growth outlook for the region, diversions across European economies, and the risk of new tariffs on European exports, which requires to have a strategy in place to profit in a broad range of market scenarios. Finally, we closed the position in emerging markets debt and redeployed into private credit to increase portfolios income generation, benefiting from the good economic environment in the US. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.